Do you know what the biggest threat to your financial freedom is when you are retired or getting ready to retire? It is not just inflation. It is not just the stock market. It is the absolute confusion and fear surrounding your credit score, specifically the Experian FICO score. I know what many of you are thinking. You are saying to yourselves, Susie, I am retired. I paid off my mortgage. I do not need a credit score anymore. I am done with debt. Oh, my metrics tell a very different story. Listen to me. Thinking you do not need a good credit score in retirement is one of the single biggest financial mistakes you can make. It is a trap. Because your credit score is no longer just about borrowing money to buy a house or a car. Your credit score is your financial report card for life. It dictates how much you pay for auto insurance, homeowners insurance, whether you can secure a rental if you decide to downsize, and it even impacts your access to certain healthcare facilities or senior living communities. If your score drops, you are leaking money. Money that you cannot afford to lose when you are on a fixed income. So today, we are breaking down exactly what the Experian FICO score is, why it behaves the way it does, and the changes happening right now that you must understand to protect your hard-earned nest egg. First, let us clear up the confusion about what this actually is. Experian is one of the 3 major credit reporting bureaus. They gather the data on you. FICO, which stands for the Fair Isaac Corporation, is the company that creates the mathematical formula used to grade that data. So when you look at your Experian FICO score, you are looking at FICO's formula applied to Experian's data. And you do not just have one score. This is what trips up almost everyone. You have dozens of different versions. If you look at your free score on the Experian app, you are usually looking at FICO score 8. But if you go to apply for a mortgage to downsize your home, that lender might look at FICO score 2. And right now, lenders are transitioning to a brand new model called FICO 10 and FICO 10T. Why does this matter to you? Because the rules are shifting. In the past, your credit score was a snapshot of a single moment in time. If you had a high balance on a credit card but paid it off right before the lender checked, you could trick the system. But under the new FICO 10T model, they are looking at trended data. This means they are looking at a rolling 24-month window of your financial behavior. They want to see if you are consistently paying off your debt every single month, or if you are slowly accumulating balances over time. If you are carrying a balance month over month, even if you are making the minimum payments, this new model is going to punish your score. Many people believe that as long as they pay their balance in full by the due date every month, their utilization is 0. No, it is not. The credit card companies report your balance to Experian on your statement closing date, which is usually 3 weeks before your actual due date. So if you charge your normal monthly expenses to your card to get those reward points, and you let that high balance sit there until the due date, Experian sees a high utilization rate. And if your credit limits are low because you closed your old accounts, that utilization rate shoots through the roof, dragging your score down with it. Now, let us address another major issue unique to retirement: closing old credit card accounts. You decide to simplify your life. You have 5 credit cards that you have owned for 30 years, and you decide you only need one. So you call up the bank and you close those 4 old accounts. You think you are cleaning house. Stop right there. You just committed financial sabotage against yourself. When you close those old accounts, you instantly do 2 things that damage your score. First, you erase a massive chunk of your available credit limit, which instantly causes your credit utilization rate on your remaining card to skyrocket. Second, you hurt the length of credit history portion of your score, which makes up 15% of the FICO formula. The system rewards you for having deep, decades-long relationships with creditors. If you close a card you have had since 1995, you are telling the formula to stop counting that longevity in your favor. Leave those old, zero-balance cards open. Let them sit in a drawer. So, what are your actionable takeaways today? How do you maintain an exceptional Experian FICO score throughout your retirement without ever paying a single penny in interest? First, you must keep your credit files active. If you have stopped using credit cards entirely, I want you to take one old credit card and link one small, recurring monthly bill to it, like your streaming service, your utility bill, or your phone insurance. Then, you set up an automatic payment from your checking account to pay that credit card balance in full every single month. This keeps the account active, It ensures your payment history remains 100% perfect, and it prevents you from becoming a credit ghost. Second, you must automate your defenses. Go into every single credit card account you own right now and turn on autopay for at least the minimum payment due. Even if you plan to pay the bill manually, that autopay is your insurance policy against a missed payment if you are traveling, sick, or simply distracted. Third, manage your credit utilization by paying your bills early. Do not wait for the due date. If you use your credit card for daily groceries and gas, log into your account bi-weekly or right before the statement closing date and pay it down. Keep that reported balance below 10% of your available limit. Finally, you must monitor your Experian credit report. Identity theft and medical billing errors are rampant, especially targeting the senior community. In 2026, minor medical debts under $500 are no longer allowed to harm your credit report, but larger errors still slip through. You can check your Experian credit report and your FICO score 8 for absolutely free directly through Experian's website or app. Check it once a month. Look for accounts you do not recognize or balances that seem incorrect. Your credit score is your protection. It is your shield against higher insurance premiums, it is your key to housing flexibility, and it preserves your cash when you need it most. Do not neglect it just because the retirement phase of your life has begun. Keep your score high, keep your account secure, and stay safe.